I'm Jono. This is QuickBooks versus Xero. Let's see where the numbers land.
The dominant incumbent and the cloud-native challenger. One holds 62% of the market because the accountant network makes leaving a relationship decision, not a software decision. The other holds 30% of the United Kingdom because it was built for the browser when the incumbent was still a desktop application. One doubled its desktop price in 3 years, while pushing users toward a cloud product that loses invoices during migration. The other admitted on its own blog that its signature feature, bank feeds, was failing at above normal rates, and the problem persisted for 2 documented years. QuickBooks and Xero, both raising prices, both generating community resentment, both producing horror stories their users describe in the same frustrated language. The incumbent whose depth creates lock-in, and the challenger whose polish is undermined by reliability. The question is not which is better, it is which friction the business can absorb. QuickBooks launched in 1992 as a desktop product that made bookkeeping accessible to business owners who were not accountants. The parent company grew from that product into an $18 billion organization. The desktop version is being retired. New sales stopped in September 2024. The annual price rose from $550 to $1,149 in 3 years. The migration to the cloud version produces documented data loss, 1,100 invoices missing in one migration, 800 transactions gone in another. A desktop update that broke installer, payroll, and company files across multiple clients. Payroll setup causing incorrect tax returns. Support described as upselling the cloud product rather than resolving problems. The depth is real. Payroll deeply integrated. Over 800 application integrations. Bank reconciliation that works. The accountant network effect keeps 62% of the market locked in despite the complaints. Xero launched in 2006 as a cloud-native platform built for the browser from the start. Revenue reached 2.1 billion New Zealand dollars by the fiscal year 2025. 4.4 million subscribers across more than 180 countries. Approximately 30% of the United Kingdom market. The cloud-native architecture means automatic updates, real-time collaboration between businesses and accountants, and an integration model designed around programming interfaces rather than file exports. Unlimited users across all pricing tiers. The bank feed instability is the defining failure. The company's own blog acknowledged above normal case volumes in March 2024. The community documentation shows daily reconnections, duplicate entries, and support responses that treat the problem as a third-party issue through 2025 and into 2026. 800 staff were laid off in March 2023. The support quality documented after the layoffs is consistent with reduced capacity, 5-day waits, dismissive responses. The performance complaints describe the software as sluggish outside fast hardware. The pricing escalation follows the incumbent's pattern. The challenger that was chosen partly for better value is narrowing the gap that justified the switch. The user model is the clearest pricing distinction. The incumbent limits users by tier. The challenger provides unlimited users across all tiers. For a business with multiple staff members who need access to the accounting software, the unlimited user model eliminates a cost variable the incumbent charges for. The difference becomes material as the business adds employees, bookkeepers, or accountant access. The payroll comparison favors the incumbent in the United States. Native payroll integration into the accounting workflow, including tax filing, direct deposit, and compliance reporting. The challenger handles United States payroll through a partner integration that works but creates a seam between payroll data and accounting data the incumbent's native solution does not have. In the United Kingdom, Australia, and New Zealand, the challenger provides native payroll compliance that matches or exceeds the incumbent's offering in those markets. The multi-currency comparison favors the challenger. Multi-currency accounting on the higher tier for businesses operating across borders. The incumbent provides multi-currency capability, but at a higher price point and with less integration depth for international payment methods. For businesses with international operations, the challenger's multi-currency handling, combined with unlimited users, is the strongest combination in this comparison. The migration comparison reveals different risks. Moving from the incumbent's desktop version to its own cloud version loses data. Moving from the incumbent to the challenger requires converting files, retraining staff, and rebuilding workflows. The incumbent's migration risk is internal, losing data within its own ecosystem. The challenger's switching cost is external, disrupting the accountant relationship. Both risks are real. The incumbent's risk destroys data. The challenger's risk disrupts relationships. Neither is reversible without significant effort. The application ecosystem comparison is close. The incumbent offers over 800 integrations. The challenger offers over 1,000. Both connect to the major business applications a small business uses. The practical difference is not the count, but the specific integrations each business requires. The incumbent's ecosystem is deeper for United States-specific tools. The challenger's ecosystem is broader for international and United Kingdom-specific tools. Someone whose accountant, bookkeeper, and payroll provider are standardized on the incumbent and whose business requires native United States payroll integration should stay with the incumbent. The switching cost is not the subscription difference. It is the professional relationship disruption. The accountant network effect is the moat. The price escalation, the migration risk, and the support quality are the cost of remaining inside it. For complex United States businesses with accountant-managed books and integrated payroll, the incumbent's depth justifies the friction because the alternatives do not yet match the combination at the same scale. Someone in the United Kingdom, Australia, or New Zealand, where the challenger has strong accountant networks and approximately 30% market share, should evaluate the challenger as the primary option. The cloud-native architecture, the unlimited user model, and the native payroll compliance in those markets are advantages the incumbent does not match at the same price point. The bank feed reliability should be tested before committing. Connect the primary bank account during the trial and monitor whether the feed maintains a stable connection over the full trial window. Someone choosing between them for the first time without an existing accountant relationship, locked into either platform, should compare the daily workflow experience against the feature depth. The challenger provides a cleaner interface that users consistently describe as more pleasant to use. The incumbent provides deeper reporting, more granular inventory tracking, and native payroll in the United States. If the business values the daily experience of using the software and operates with a distributed team where unlimited users matter, the challenger fits. If the business needs the deepest feature set and the broadest accountant compatibility in the United States, the incumbent fits. Someone evaluating the pricing trajectory should understand that both platforms are increasing prices. The incumbent doubled its desktop price. The challenger restructured plans and raised list prices. The gap that made the challenger the better value option is narrowing. The comparison in 2026 is less about price difference and more about which product's limitations the business can work around. The incumbent's limitation is a forced migration that risks data loss. The challenger's limitation is bank feed instability that undermines the core workflow. The support quality comparison is poor on both. The incumbent's support upsells the cloud product instead of resolving problems. The challenger's support treats bank feed failures as third-party issues. Neither platform provides the support experience the subscription price implies. For businesses that need responsive, knowledgeable accounting software support, neither platform delivers it consistently. The product that launched in 1992 because a business owner should not need to be an accountant, and the product that launched in 2006 because accounting software should not need to be adapted to the web are now the two dominant platforms in their respective markets, both correct in their founding thesis, both generating the same community resentment. The incumbent raises prices, forces migrations, and holds the market through accountant lock-in. The challenger raises prices, acknowledges bank feed problems, and holds its markets through interface quality and cloud-native convenience. For the business choosing between them, the question remains which friction fits. The incumbent's friction is structural. The challenger's friction is operational. Neither is frictionless. The business that chooses either platform accepts the friction that comes with it.